he's out looking at a property right now. So he'll be back next week. I want to thank you all for joining us at Rev. Service is at the heart of everything we do, and these webinars that we hold weekly are one of the ways for us to give back to the community through education. Today, we'll be talking about underwriting. As you guys probably already know, that's a very deep subject, and we could probably spend days going into the weeds. But with our limited time being to an hour, we will keep this at a high level and discuss kind of the key elements that go into evaluating the potential financial performance of multifamily properties. With that said, I'm super excited to introduce our guest speaker today, Will Hahn. Will has a bachelor's of science in applied and computational mathematics, or that is a mouthful, from the University of Southern California, and has been working in Medicaid consulting as a credentialed actuary for over 5 years. With a strong client-oriented work ethic and data-driven decision-making, he is focused on building risk-averse strategies in commercial real estate. He plans on continuing to build a network portfolio with positively impacting involved communities. So I want to thank Will for joining us today.
Thanks, Jim. I just want to say it's always an honor to be speaking in front of other like-minded individuals. And for those of you who are not familiar with what an actuary is, it's more of a risk management for insurance companies usually, but I work in a more niche in Medicaid side where we set Medicaid rates for state governments. So there I work with financial modeling day to day, building models in order to calculate what the right Medicaid rate is for each state based on the acuteness of the population that's Medicaid eligible. So I have about 5 to 6 years of experience working with Excel and financial modeling, and have been trying to bring that into commercial real estate, into specializing more in the underwriting process. And as Jim was, go ahead.
I was going to say, I've had the distinct privilege to watch some of the Excel magic that Will can do. It amazes me. And as we all know, folks, the underwriting world, it's about being able to read the numbers and paint a picture from the numbers. And I've seen firsthand Will's excellent ability at doing just that. So super excited to have you, Will, and super excited to kind of dive into today's topic. Why don't you take it away for us?
Perfect. And just want to reiterate what Jim was mentioning in the first couple minutes, where because of the time and the group of people we have, so that we make it beneficial for everyone, I'm trying to convey how I think through a property from when we get the property to analyzing the property, rather than going through cell to cell within the underwriting model. Because there are so many different underwriting models that are out there, I just want you guys to get to the same thinking process that I go through when I'm analyzing deals, not changing this sales formula into whatever. So let's focus on that. And with that, let's get started. Let me just share my screen real quick. Let me see if this works. Are you guys seeing the actual slides, or are you guys seeing the admin version?
We got the slides.
Okay, perfect. So yeah, so today I will be. Let me just use it this way. Apologies. So today we'll be going over the pillars of underwriting, and I'll be discussing at a higher level on different aspects of underwriting as I go through. So a couple of different pieces that I wanna hit on. So before we even dive into this, what does it really mean to underwrite a property? We can really go down the rabbit hole from the get-go by talking through the financials, the rent roll, the T12, et cetera. But to me, it really boils down to creating a story or a narrative for that property. So, what did the property go through in the past? What can we do to improve it physically and financially so that it fits our business strategy? And I mean, of course, at the end of the day, we have to get the numbers to support the narrative as well, that's where the underwriting tool comes in as well. And that being said, I do want to jump into the slide and want to share some of the things to look out for at the market level, property level, and once we actually dive into the underwriting model and some red flags that you need to watch out for as an investor.
And guys, just interrupting real quick, if you guys have questions, just a reminder, throw them into the chat. We will try to answer them as they come in, and we'll have a Q&A session here at the end as well. But if things are popping up as Will's going through stuff, please throw them into the chat, and we'll get to those.
Sounds good. And Jim, don't as I finish each section, if you see any questions that seem fit, I'm not going to be focusing too much on the chat section. So if you can just bring them up to my attention, that'd be great.
Will do.
Perfect. So I do want to start by going through the market research. The property itself is very important, but choosing the right market to invest in is also very crucial. And when we look at different markets to invest in, there are some metrics that I always look at to hone down on whether it's a good market or not. Some of the important metrics that I look at are population growth, job growth, diversity, income growth, house value growth, crime index, rent growth, and market cap rate. I'm going to go through each one and explain why. And just to bring your attention to me, I'm just going to stop share for a little bit and make it into more of a grid view so that we can see everyone's faces. So population growth is almost intuitive one because it directly relates to the demand of the rental properties. I like to see at least about 2% average annual population growth for smaller markets. Maybe about, I'm going to define the smaller market as about 250K population, and at least about 1% for larger markets, maybe more than 1 million people for a larger market. I'm going to define it as for this presentation purposes. And then we have the job growth, which is very important, since the companies and jobs coming into a certain market will signal a higher demand for the rental properties as well. And for those two, I like to see at least 2% average annual growth for smaller markets and about 1.5% for the larger markets. So what some people I feel like they miss in the job market when analyzing a certain market is job diversity as well. I think that's a really important factor because, for example, if there's only one type of job in a market that's, let's say, related to one military base, if that military base ever moves out or closes down, that would mean that the property itself will lose a good chunk of our paying tenants. And at that point, it becomes very difficult to get the occupancy up and recover, or even sell at the end of the day. So we want a market that has a lot of job diversity so that even if one sector ends up leaving or one sector or industry ends up leaving that market, we still have other jobs to support our tenant bases. Then we have the income growth, which will determine how much we're going to be able to push the rents based on the affordability in the area. So looking at a market with strong income growth will be good for our business plan because that just means that we have a lot of room to push up on the rent. For this one, I usually look for at least 2% average annual income growth where it's a small or large market. And it's pretty similar story for house value growth. If the house value grows fast, people are not going to be able to afford to buy those houses because they can't afford to pay those mortgages, but they're going to have to go into renting from apartments. And those higher income tenants will be able to pay more renting because they still can afford it'll still be less than paying a high mortgage. And the increase in house prices will also kind of trickle into the appreciation of the multifamily asset as well. So for this one, I try to look for at least about 2.5% average annual growth, whether it's small or large markets. And then next one is crime index. I try to look into crime index in the market to say really how dangerous the market is. But this one, I just keep it on the back of my head and just take the values with a grain of salt, because I truly believe that any market has pockets of gems that we can find, even if there are areas of higher crime rates. there are areas where I feel like we can definitely find opportunities in. Then we have the rent growth. Rent growth directly relates to the income side of managing a property. And the faster we can increase our income side, which is primarily driven by rents, the better our returns are going to be for our investors. So for these, I look for at least 2% average annual rent growth for all the markets. This one I will go into a little bit more detail into in some of the other slides. Then lastly, I look at the market cap rate to gauge how strong of a market we're in. Lower cap rate market will mean that people are willing to pay more for a property compared to a higher cap rate market. And this is going to come into play when we're looking at the underwriting model section. And when we're looking at all these metrics, let me go back to the slide so that you guys have it all on your screen. Give me 1 second, let me share the slide. So when we're looking at these metrics, there are different resources you can tap into. And I think I saw some comments pop up about where I can pull these. I always look at US Census data. There's a website that I look at called bls.gov. I look at city-data.com, etc. And there are other websites by the bigger research companies. I also look at RealPage and all of those websites to pull these data and analyze them. You know, not every time, maybe once every other quarter or anything like that, to keep myself up to date from these different markets. And as an investor, you probably would like to see these metrics from the deal deck that you're looking at, so that you know that the operators are doing their homework. But also, it doesn't hurt to do some research in the market that you're interested in as well by yourself, so that you can confirm what they're saying is true as well. And before I go to the next section, I guess I can open up the questions. Jim, did you have any questions that is applicable here?
The one question we do have is, are you willing to share these slides at the end of this?
Oh yeah, for sure. I mean, this is at a very high level, and then I have my contact at the end too. So don't hesitate to reach out if you want this information as well.
Okay, and we do have one other. So what you actually answered the what website information? Okay, perfect.
Right. So yeah, if you reach out to me afterwards as well, I can also send you some websites that I use to pull these information from.
Hey, Will, would you mind?
Not limited to those.
Would you mind just saying those ones one more time? I'll put them in the chat.
Sure. US Census data. Next one is bls.gov. Next one is city-data.com. And a lot of research in RealPage. RealPage has a research column, I think, or a section in their website that has a very good list of documents and articles to read, where I pull a lot of the data from.
Hey, Will, I got a quick question for you. So
Sure.
you pull this historical data, and you looked at house appreciation values and whatnot. How much do you factor in the fact that if you're in an area where you've seen really strong appreciation in houses over the last 5 years, maybe that market's getting a little choppy or peaky? How do you factor in that market might be overbought? I mean, if you're looking for strong growth, maybe you're on the back end of the curve if you're picking that up now.
Yeah, so the reason we look at the house prices is more of the affordability side of it. If it, just like what you're saying, if it's hitting the peak, it's most likely that a lot of people are starting to not be able to afford the mortgages, where they're going to start turning into the rental market. So that could be beneficial for us. And especially in multifamily, we value it a little bit differently than single family homes, where it's in the value add strategies. There are different strategies other than betting on the appreciation side of it, so that we can still add value even if we buy it in a strong market already. And then once you add those value by adding things like valet trash service, covered parking, so on and so forth, you can actually force the appreciation on the value add properties in multifamily.
Thank you.
Yeah, of course. Great questions. Okay. And with that, I do want to move on to the property specific details. So now that we feel confident about the market we invest in, some things I look for in a property is the location and class, physical characteristics, unit mix, capital improvement history, and rents compared to the market. And let me go through each one again and explain why. And honestly, I think for this one, I think I'm just going to leave the slide up. The first step when I start underwriting, I look at the property's location and class because that'll determine the business strategy. So this kind of loops into what Beck was saying as well. If the property is located in a C or D neighborhood, the tenant basis is more likely to have a little bit more problems compared to an A/B neighborhood. Also, the business plan varies whether we're dealing with A, B, or C class property as well. Where class A will be adding more of a service-based value add strategies like valet trash service, because they will already most likely will have a premium interior already built in, because they'll either be a newer buildings or a new construction. Whereas BC properties probably has a bit of potential to perform a major interior renovations. So based on the different location and class, we're going to have different business plans, which will call for different risk and return as well. Typically for AB class, more AB class will have a slight lower return, but will be much safer because it has a strong rental basis. Whereas CD might be a huge value add play where it could be struggling for the first few years because there needs to be a lot of cash influx in order to turn the property, but it may have a strong return on the back end after you gentrify the area, hopefully. Then we have the physical characteristics of the property. So some things I look for in the marketing package as an investor from the operators who are putting the deal together is the age of the property, age of the roof, is there a curb appeal, or what will be there after the business plan is done, and is the property master individual meter for utility, and then what are the available amenities at the property like pool, gym. And depending on the availability and condition of all those pieces, we can come up with the business plan that will bring us and the investors the most return on investment on the capital improvements. So all these are going into the formulating the business plan for the property. And speaking of capital improvements, I also look at the capital improvement history of the property. Sometimes those information is readily available. And this provides me a little bit more insight into what kind of work was already done. What are some of the renovation status of the units that were already renovated, so that we can gauge how much work and money will need to go into each of the units or different unit types so that we can gauge how much money we need to be holding for interior, for exterior, or amenities renovation so far, which will kind of segue into the new buyer, our strategy. And then we have the unit mix. I feel like this is missed in a lot of underwriting model, because this is more than just numbers. This is more of feeling out the demographics and being able to cover a lot of customer segments. Because the numbers could be very great on the property, but unit mix could be struggling. I also like to see a healthy mix of unit types with a bit more weight on the 2 bedrooms, because that really covers a wide variety of tenants. If the property is primarily studio-based, let's say it's 70–80% studios, we'll just be restricting the tenant demographic to potentially young professionals or maybe young couples. Once they start having kids, those are going to be too small, and we're just restricting our property to those demographics. So we do want a unit mix that will support a wide range of tenant demographic, including families. And then lastly, there are rents compared to market. You always want to see a rent comparison to similar properties around the subject property. And one thing that you want to see here when you're going through the deal deck and looking at the sales comps or rent comps is to confirm that the comparable properties that we're looking at have a similar vintage and class to its so that it provides a better representation to the subject property. Because once you're comparing a property that's a C class property to a B or A minus property, you're just going to be over projecting on the rents, where you are going to be much lower because of the quality of the property. So it's crucial to see and make sure that you're looking at a similar type of properties when you're looking at rent comps. And with that, do you guys have any questions on the property side? Okay, great. Then and so now that we feel good about the market and the property itself, we can now dive into the underwriting process. So as you guys can see, there's a lot of the foundational work that goes in to validate the market and the property itself before we can actually even dive into the properties. But the thing is, once you identify the market side and everything, you can actually feel confident about the market and dive into different properties within the market. So it's not done every single time. There are different items when I look at in the underwriting model side as well, including some of the big pieces are income statement, rent roll, business plan, debt situation, exit strategy, different stress tests. And as I mentioned in the beginning, there are different underwriting models out there in the market. So first of all, the income statement. It may seem like there's a lot going on in the income statement, or interchangeably used words are financials, or the T12, the trailing 12, which is the financials for the last 12 months of the property. However, all of this is really a segmented view of the income and expense side of the property. An income side usually consists of the gross potential rent, which means the total amount of rent that we can get if all rents were up at the market level. And then it is offset by a few different factors, including the loss to lease, which is essentially the difference between where the market is at and what the property is currently getting. And there's bad debts, where tenants are failing to pay the rents, and concessions, which are discounts given to the managers or maintenance personnel. So once those income side is taken into account, then there's the expense side. So we usually look at the expenses by different buckets because there are so many line items in the financials. We try to aggregate them into, I usually use about 12 different buckets, as you see on the screen right here. And I can actually go through each one of them and kind of briefly explain what they are. General admin, you got to keep the offices running. You got to keep the property rolling. So that's why there's a certain amount of money going into general admin. In payroll, there's on-site managers, on-site maintenance personnel that we need to pay for, including their paychecks and their the insurance and potentially the workers' compensation. There's advertising that has to go in order to keep our occupancy up to battle our normal turnover of the property. And contract services, there could be pest control, there could be snow removal for certain states, so on and so forth. And it repairs and maintenance. It's just general maintenance that goes into the property, just a fix up. There could be a pipe burst that you need to take care of. Turnover, just a touch up after someone leaves, a tenant leaves, so that it's ready for the next person. And management fee, that's an important thing that you always want to check, that there is a management fee assumption in the underwriting model, because we will be using a third-party management company in order to professionally manage the property, because either they are local, essentially. And insurance and taxes are those are pretty straightforward, and the different utilities that go in. And I usually look at two different views of the expense side. On the left side, these two columns, you see the current. This is just one of the properties that we were looking at. So don't pay too much attention to the numbers themselves, but I look at the current, what they're currently experiencing. This is based on the T12. And I look at the year one projection, which is our projection of what the expenses are going to be. And essentially, I try to be at par or above what they're currently experiencing, because after talking to a lot of different operators and sponsors, realize that yes, you might be able to find efficiencies in the expenses. However, a lot of the times it usually becomes the case where you're experiencing about the same or more for the expense side as you're trying to turn the property. And that's why we go through these items to verify them. And we also confirm these with the property management company that we're working with, because they have more experience with the properties nearby, so that they can actually verify what we're holding is in par or on par with what their expectation is. So once this deep dive on the financials is done, then I look at the most recent rent roll. So the global, I look at the rent roll. So the goal here is to see the level of rents the current property is able to achieve, along with the vacancy level of the property, because it's going to play a big factor into what kind of debt we can get. So for example, in order to meet the qualifications for an agency or permanent debt, you'll need to be at 90% or higher occupancy in the last 90 days of the property. I mean, yes, there are cases where you can file an exception if you have the right story and you're very close to that 90%. But I'm just generalizing here and just speaking in general. And also shown in this picture below, I do a quick summary of what kind of rents we're seeing by different unit types to see, what the unit distribution is, what they're averaging currently, what the current achieved highest rent is, and what we're trying to achieve at the market level. So I slice and dice both the financials and the rent roll so that we get an aggregate view of the property. Then to the business plan. I did touch on this point in the last couple of slides while I was going through market and the property as well. But knowing the business strategy is key in multifamily investing, both as an operator and as an investor as well. But more importantly, it's crucial to know how to reflect it in the underwriting model. So for example, if the plan is to renovate all of the interiors and increase the rents over the 2 to 3 year time frame, you'll want to see the higher loss to lease number for the first couple of years, because that would mean that for the operators to fix everything, it would mean that there's a lot of rents to catch up to the market. So loss to lease, which is definition for difference between the market rents and what they're currently experiencing, we're still going to be seeing a lot of it in the first 2 to 3 years as we're ramping up the renovations and carrying out the business plan. So we're going to see that for the first few years, and then we'll drop the loss to lease at stabilization, or once all the renovations are done and we're able to push up all the rents. So that's just one example of it, but there will be a lot of factors that interact with changes like that, where loss to lease decreases, which would mean an increase in income, and that would mean a decrease in expense ratio. So it's important to understand how one factor really affects the other factors in the underwriting model, and how business plan kind of incorporates into all that together. And another thing to keep in mind is the debt situation. Is the property offered free and clear from the previous owner? And if that's the case, have the current buyers considered seller financing or creative financing? And if there's some debt left on the property and the previous owners only owned it for 3-4 years, are we exploring options of an assumable debt? Because right now we are in a higher debt environment or interest environment. I've actually seen a lot of deals come through that are assumable debt as well. And once the debt structure is determined and plugged into the underwriting model, there are other factors that we need to account for, such as loan to value, which means how much of the property value we can get a leverage on, and making sure that we meet the lender's DSCR requirements as well, which stands for debt service coverage ratio, which is just the ratio of the net operating income to the debt service amount, including the principal and the interest. So for example, for agency debt, they require anywhere from 1.25 to 1.35 DSCR, which means that the net operating income of the property each year will need to exceed the mortgage payments by a factor of 25 to 35%. And once those are all determined, you will want to pay attention to the exit strategy that the model has built in. So how long are the current buyers or operators that you're investing in planning on holding the property? Have they considered an option for refinance? And what kind of precautions are they building in for this refinance in a turmoil environment like we're in right now with the debt market, with the economy in general? And what is the exit cap rate assumption, and how does it compare to the current market rates, market cap rates? How much is it over the current market cap rate, or we call it the reversion cap rate? And one of the most important things in underwriting model, after all those are taken into account, is how much conservatism or buffer it has. So it's important for you as an investor to know what kinds of conservative measures the underwriting ended up building in. A couple of examples could be yearly rent and expense increase. So as you guys are aware, we've been blessed with a very high rent increases the last few years. You know, some areas were even experiencing double digit. However, now that we're essentially in a recession, 8 to 10% plus year over year rent increase probably is too aggressive. So once you see that, that's definitely a red flag. Another example is on the expense side. As we see here, I kind of skimmed over it when I was going over the expense side, but while we want to be as efficient as possible on the expense side, we don't really see the expenses dropping after taking over the property unless the property was very mismanaged and have a very high repairs and maintenance, because there's a lot of deferred maintenance or stuff like that. So as you go in and fix up a lot of things, there is a potential that it drops, but I'm speaking in general here again. So when I'm underwriting properties, I try to stay level or above the current expenses, as you see that I'm doing here when we compare the current expenses and year one projection. And there are many other ways other than what I just mentioned to build in conservatism into the model. And it's important to know what the operators that you're investing with, how they're incorporating these conservatism into the model. And another thing is the stress tests. You always want to see before you invest into an operator slash property that they are stress testing. Are they testing different interest rates? If they're refinancing, are they stress testing different interest rates when at the time of refi in order to make it happen? Are they stress testing with different rental increases or expense increases, so that we are ready for the unforeseen events or circumstances? And then lastly, I want to close this section with that there are different underwriting models that are out there. And as an investor, I strongly recommend you to get an understanding of the underwriting model and how everything that we just talked about flows into the model, rather than, hey, this specific assumption is on this tab, this cell, so on and so forth, because there are just so many different underwriting models that are out there that do the job, and they are analyzing correctly. Just has a different view. So it's crucial that you understand how the different pieces are incorporated into the models rather than just learning one single model as an investor. So make sure if you need to ask questions to the operator, as long as you have these things in your head that, hey, are these pieces getting accounted for, and where are they getting accounted for? You can ask more effective questions to the operators in order to find that these are getting accounted for in the model. This one, does anyone have any questions on this section?
I got a quick question. Where do you factor in economic drivers like inflation? Inflation could definitely affect your cost on the side of the thing. Or do you just assume that inflation is any increases in costs are going to be offset with increases in revenues?
Right. So those are incorporated for. Oh, go ahead. Oh, okay. Yeah, those are incorporated for in the rent increases and expense increases. So every year we incorporate. There's a rent increase for most of my models. The starting point is about 2 to 3% rent increase year to year. Same with expenses side. And with inflation, usually I used to use about 2% expense increase year over year, but I had to bump that up to 3% in the last couple quarters because the expenses are also increasing at a much faster rates, and then with inflation, it actually surprisingly helps the multifamily side because that would just mean that we are able to push the rents more than what we would usually see on the regular rent increase side. So inflation, in a way, helps out the multifamily investors because we are able to achieve that target rent much faster. So in the inflationary period, last couple of years, we've seen a lot of deals that were able to achieve what we were thinking that we would get at the end of year 4 or something at the end of year 2 because the rents were pushing so much faster than expected due to inflation. Does that answer your question?
Yeah, no, that's great. And in fact, that's kind of why one of the reasons I want to get into the multifamily stuff because of my inflationary concerns. Right.
So multifamily is a great tool to fight inflation in a way because you're kind of taking advantage of inflation because of the rental growth that you're able to push. Great question. And lastly, I want to go over some of the red flags that you should always watch out for. Before I dive into each of them, though, I do want to caveat that these are just rules of thumb that I use when I'm looking at the deals, and they are very, very, very much market specific. So just because you see one of these red flags, it doesn't mean that it's a crappy deal. But that these metrics are very market specific. So you got to know your market essentially in order to see what the true red flags are for that specific market. So first of all, there's the expense ratio. If the expense ratio, which is just the ratio of the income side with the vacancies accounted for and the other incomes accounted for, the ratio of that income to the expenses that we just discussed, if that is lower than 50% at stabilization, what I mean by stabilization is after all the renovations are done and we're able to pull up all the rents to where we want it to be, it triggers a red flag for me. So usually after all of the expenses are accounted for that I shared on the other on the last slide, the expense ratio should end up around 50% for a lot of markets. However, I can give an example about the market specificness, if that's a word, where for areas like Phoenix, we're going to have a lot lower insurance because we don't really have natural disasters here. And we have very low taxes as well because the Maricopa County only limits the taxes to go up by maximum of 5%, even at reassessments every year. So that's why those two expense buckets are much lower than the other areas. which puts Phoenix at like a 35% expense ratio, for example. So just like that, it's very market specific, but just in general, it's about 50% is what I'm trying to say. And I also like to see the models holding at least 1,000 per unit for operating reserves, because there will be unforeseen circumstances when we're dealing with a building and operating a building, and holding that at least that amount for operating reserves will be needed one way or another. And not seeing anything or seeing anything below that will cause me to think that there could be something going on or not enough reserves, really. And the third one is no cash flow year one. If there is no cash flow year one, that's a red flag for me. Granted, if the investment is very heavy value add, as I was saying before, where the operators are trying to gentrify like a CD neighborhood property into a B, and they're just putting a lot of cash input on the front end, and much higher tenant turnover because they're trying to turn the tenant bases as well, that can cause the cash flow to struggle the first few years as they're going through that transition. So as I mentioned, not just the market, but it really relies on the business plan as well. And you gotta think of it as more of a holistic view rather than just saying, hey, there's no cash flow year one. This is just a crappy deal. I'm out. Even if you see that, yes, it is a red flag, but still take a look at the holistic view of things. And then I briefly touched on the next two topics on the last slide. But if the economic vacancy, which means the physical vacancy, literally people are not in those units of the property, plus loss to lease, bad debt, and concessions. So all of that aggregate is defined as an economic vacancy, is too low, which for me, threshold is 8%, I start questioning the model and the property. Again, this is very market specific because, again, places like Phoenix, where there's still a lot of influx of people coming in and a lot of jobs coming in, so it's a strong market, it may see a lower vacancy because of there's always a demand for apartments here, at least right now. And similar story for rent growth. We've been blessed again with double-digit rent growth in certain areas past few years, but underwriting is not the place to be pulling strings like that. We want, as I mentioned, we want to be as conservative as we can so that we are ready and have buffers built in for unforeseen circumstances. So even during the double-digit rent increase times, we were underwriting with much lower rent growth assumption so that we are safe for the upcoming years when we go into more of a steady period instead of a very high rent growth. And lastly, this is something that even I haven't really thought through before much until about 6 to 8 months ago, where some people have brought it to my attention. I think this gets unnoticed, but I think it's always helpful to see how much the GPs or the operators are getting paid from the deals as well. Because there are times where in order to provide the investors the most returns, the operators end up giving up their share of the deal, essentially working for free for a few years. While that may look good on paper and to the investors, I truly believe that this is a problem because the operators may be determined and passionate in the beginning, trying to get all this done, but they have to keep the lights on, and there is a potential that the motivation level drops midway through when they're essentially working for free. So it's just something to keep in mind. It's not. It could be the case where the operators are fine, and the amount of money that comes on the back end for everyone kind of makes up for it and everything. But it's just something to keep in mind that was brought to my attention that I thought was very interesting. So yeah, that's all the red flags that I wanted to go through. So today we went through the understanding of markets, the property, and the underwriting model, and some of the red flags that I want to point out. But I want to close by emphasizing that as an investor or other operators on the call, it's crucial to understand the process, not trying to regurgitate what cell, what formula, and so on and so forth. So even if you're not fully underwriting the property yourself, being able to understand it and being able to ask the right questions, right effective questions, so that the operators, you understand their business strategy and what they're trying to implement, and seeing that how all of that plays out in the underwriting model is what I try to. That was one of my goals with this webinar. And with that, I do want to open it up for any questions that anyone has, other than the ones that we already covered during the meeting. Let me just stop share.
So, well, let me jump in and say thank you so much for all of this wonderful information. It's a lot to digest, folks. I think we all recognize that, and becoming a underwriting expert may not be in the cards for some of us. And as Will stated, it is extremely important to at least have some foundational knowledge to understand who you're investing with is their plan is, right? What their business model is, how they plan on taking a property and making it profitable in the end. So everybody has a great payday, and that they are taking into account, changing in market conditions and doing a very conservative approach. We've seen where folks have gone in and there's a lot of knobs to pull and dials to turn and underwriting models. And, I've been around accounting folks long enough that know there's a lot of little nerd knobs in there and accounting magic. I mean, you look at our government right now who can't raise the debt ceiling because nobody can come to an agreement. And what do they say? Well, we're going to fake the numbers for 6 months. That's accounting magic, which is crazy. But that happens in underwriting too. So it's very important that you guys understand how these models work, what goes into them, the markets that you're going into, the types of property, how those properties compare to other properties in the same area, and see the story before you invest your hard-earned money into that deal and into that operator. And again, Will, thank you so much. I really, really appreciate it. Do we have any other questions before we wrap up?
Yeah, are we going to get Will's contact information?
Yes,
Oh,
I
well,
just put that on the chat. I noticed that I didn't share my last slide, which had my email on it, but I just put my email on the chat. If you want to reach out to me, I'd be more than happy to chat with you about anything.
Thank you.
Yeah, if you want to dive into more nitty-gritty details, we can do that too. But I just wanted to avoid that from happening in this meeting because we already spent 50 minutes just talking high level.
Yeah, I've been in conversations with Will, and it can go very, very deep dive into some of this stuff, folks. So there's a lot to learn here, and it takes time and experience, but that's one of the reasons why we partner with Will and looking at properties using his expertise. And I'm not the end all be all numbers guy who can, spend hours pouring through all that stuff. It puts me to sleep, honestly. But for guys like Will, it excites him. So that's why we all have our places in the world, I guess. Let's see. So Will, one of the questions, are there any courses or underwriting tools that you would recommend? So
obviously I'm not an affiliate or anything like that, but I personally built mine off of Michael Blanc's SDA, syndicated deal analyzer. I believe you can purchase that on the Michael Blanc website for, I think it comes with a course too. I think for like $175 or something. So it's not. I believe it's a really good investment. It gets a deeper understanding of the stuff that I went through, and how that kind of flows into the model as well. So I think if you want a good understanding of the model and get to know one of the models that are out there, I think the SDA definitely hits the spot. But that doesn't mean that the other models that are in the market are wrong. It's just what I use.
Well, everyone, thank you so much for joining us today. Really appreciate your time spent with us. Hope you got some value out of this course. Will, again, thank you. Thank you so much for putting this together and sharing all the information. We'll take Will's presentation and get it sent out to all the attendees here on Zoom. You guys now have Will's contact information as well, so feel free to reach out to him. And always feel free to reach out to any of us here at the Rev team. Always happy to engage and talk real estate with you guys. Again, thank you for your attendance, and we'll see you guys next week.
Or sooner.
Or sooner.